Welcome to The Explainer. Today, we're diving into something huge for Papua New Guinea's economy, a brand new Income Tax Act. Now, this isn't just some minor tune-up. We're talking about the first complete rebuild of the country's financial engine in over 60 years, and it's all set to kick off in 2026. So, what's actually under the hood? To really get a sense of just how big a deal this is, let me start with a quick question for you. What on earth could the first moon landing and Papua New Guinea's old tax law possibly have in common? You guessed it. They're both basically from another era. PNG's last Income Tax Act was passed way back in 1959. I mean, just think about how much the world and PNG's own economy have changed since then. Yeah, it was definitely time for an upgrade. So why the massive overhaul now? Well, this is about way more than just changing a few tax rates. This is a ground-up redesign meant to build a tax system that actually works for a 21st century economy. So what's the game plan with this new law? You can pretty much boil it down to a few key goals. First, make it simpler and cheaper for everybody to pay their taxes. Second, attract more investment by bringing the rules into the modern age. And third, really strengthen the whole system's integrity, closing loopholes and making sure tax breaks actually make sense. And you don't have to take my word for it. The government's own summary says the goal is to create a law that is clear, concise, and adaptable. And you know, that last word, adaptable, that's the real key here. It's all about building a system that can actually grow and change with PNG's unique economy. Okay, let's get personal. What does all this actually mean for you and your paycheck? Let's break down the changes that are going to affect your salary, your deductions, and any of those special payments you might get. All right, first things first. The main tax that most of us are familiar with, the salary and wages tax, or SWT, that's not going anywhere. The basic idea of your employer taking tax out of your pay every fortnight, that whole process stays the same. But here's what is changing: the way your total income is calculated. The new law makes it crystal clear that your taxable employment income isn't just your cash salary anymore. It now officially includes all those allowances and non-cash perks, like a company car or housing. The goal is to make things a lot fairer across the board. Now, here's some really good news for employees. If you happen to be leaving your job, the new act brings in a special lower tax rate for some redundancy and long service leave payments. That's a pretty big deal and a welcome bit of relief for workers who are moving on. All right, let's shift gears and talk about the business world, because the changes here are just as massive. We're looking at a whole new, much simpler framework for everyone, from the smallest sole trader to the biggest corporations. And one of the biggest changes is for the little guys, the small entrepreneurs. If you're running your own show as a sole trader and your yearly turnover is under 60,000 kina, you get to use a brand new, simplified small business tax system. It's designed to slash the paperwork and make being compliant way, way easier. So for any business, a huge question is how you handle the value of your assets going down over time. Depreciation. The new law gives you two clear options. You've got the straight line method, which is super simple. You just deduct the same amount every year. Or you can use the diminishing value method. This one lets you take bigger deductions right at the start, which can be a massive boost for your cash flow when you're getting going. Another really basic concept that the new law clarifies is when you count your money for tax purposes. For most individuals, it's the super simple cash basis. You count the money when it actually comes in, and you count expenses when you actually pay them. But for companies, it's a different story. They're required to use the accrual basis, which means income is counted when it's earned and expenses when they happen, even if no cash has changed hands yet. And this massive reform isn't just about what's happening inside PNG. It's also about making sure the country is lined up with the rest of the world, adopting global standards for how it handles international business and foreign investment. Now, here's a term you'll hear a lot in international business: permanent establishment. It's basically the legal measuring stick to figure out if a foreign company has a big enough presence in PNG, like an office, a factory, or a mine, to have to pay taxes here. By updating this rule, PNG is getting on the same page as the rest of the global economy. To tackle a common way companies avoid taxes, the law is bringing in something called a thin capitalization rule. So how's it work? Well, imagine a foreign-owned company in PNG that's loaded up with a ton of debt from its parent company overseas. This new rule just checks its debt-to-equity ratio. If it's got way too much debt, we're talking more than a 2-to-1 ratio, the law can actually limit how much interest it can claim as a deduction. It's a clever way to stop profits from being drained out of the country. Okay, now for one of the biggest headlines to come out of this entire reform. For the first time, PNG is introducing a capital gains tax, or CGT. This is a tax you pay on the profit you make when you sell certain valuable assets. At its heart, this new capital gains tax is pretty straightforward. It's a tax on the profit, or the gain, that you make when you sell a specific kind of asset. It's all based on the difference between what you originally paid for it and what you sold it for. Simple as that. So, what exactly counts as a taxable asset? This is the really important part. The government has kept the focus for this new tax very, very narrow. This isn't about the sale of your personal house or your car. It mainly targets the really high-value assets connected to PNG's resource sector. We're talking things like mining rights, shares in resource companies, and that sort of thing. And the rate for this new capital gains tax? It's set at a flat 15%. So with all these huge changes on the table, from new rules for small businesses all the way to a brand new tax, it's pretty crucial to know the timeline. How do we get to this point, and when does all of this officially start? Well, it's been a long road, that's for sure. I mean, we start way back in 1959 with the original law. We fast forward all the way to today with the new bill replacing it. And the official go-live date, the day this new era begins, is January 1st, 2026. And just to be absolutely clear, this is a full-on replacement. The old 1959 Act is being completely repealed and thrown out. But, and this is an important but, to make sure big investors have certainty, the new law specifically protects existing agreements for major resource projects. So any deals that were signed under the old rules will still be honored. So what we have here is a modern financial playbook, built to be clearer, fairer, and a heck of a lot stronger. And the big question it leaves us with is this. With these new rules of the game, is Papua New Guinea's economy now truly set for the next 60 years? I guess only time will tell. Thanks for watching The Explainer.